So I'm really happy to have this opportunity to talk with you guys about valuation. So I have this presentation about 25-30 minutes with the main topics, with a kind of introduction in the valuation world. After that, to have some opportunities for questions and answers. I know that each of these topics could have a long conversation, but I really believe that I will bring some important points. So the agenda will be, first of all, the framework for business angels, how valuation works for business angels. Then we will talk a little bit about the fair value and also about methods, comparables, and deal terms, because in the end, the valuation is not just about valuation, it's about a puzzle of pieces. So before starting, I'm just sharing this quoted from Damodara. Damodara is one of the experts about valuation in the world. He's professor in New York University, and he was talking about the relativity in the stock markets and the difficulty to apply this kind of approach in valuation, but not even Damodara was ready for the relativity in seed startups. So just bring this topic and show the challenge that we have, that is talking about valuation in pre-seed and seed phases. So before starting, some thoughts about valuation. Of course, we know that the valuation will always depend on who is evaluating, why you are evaluating, when and what. For example, a bottle of water in the desert, it's a classic example, but how easy is to understand the pricing of NFTs right now and of arts and so on. So what we are evaluating will make difference. So the startups is not the same. We are using the term startups for companies who are starting, but we have different stages, different industry, different business models, so they are different. But also, we also depend on why you are evaluating. So we are doing a minority investment, it's an acquisition. For what reason we are evaluating? So just to bring some important thoughts about valuation in these phases, I just to talk about the entrepreneurial framework that we are facing, because in this phase, we all know that we have a lack of information. Probably we will not have a historic about the company. And also we have a lot of uncertainties about the future. But here we all talk about the future, the potential of this company and the new technology, the disruptions. So you are in a space with fewer information and you need to make a decision. So this is totally normal in this space, and you need to understand that in this phase we have lack of information and this situation. Also, in that moment, for me, most of the cases we are pricing the deal. We are not just talking about the valuation of the company and the assets and how cash they are doing, but we are pricing the deal. So in other words, we are changing some money for equity, and maybe this will be a consequence of a valuation. So here we have this kind of pricing, but it's important to understand when we are talking about pricing that sometimes we can pay more for a better product, and sometimes we can pay less for other kind of product. So you have here a kind of competitive point. So you need to understand, we need to compare. It's important to have this kind of philosophy. And just to conclude about the valuation in this pre-seed and seed phase, we angels, sometimes we are not deciding just about the financial return, about the gains. And this is also about a personal decision. Sometimes this could bring you some status, some part it can be for your self-development. Maybe you are participating in that industry a long time and you want to be part of a new technology in the same space. So in the end, the personal decision will have a huge weight in your decision. So it's important to keep this on mind. To start, I bring here the startup financial cycle. We all know about this, about the value of the debt, the cycle. So here I have the angel and seed phase, also have the early stage and mid stage here in this chart. And we know the startups has the financial with the seed, Series A, Series B. In the beginning, you have few players financing the startups, you have some bootstrapping, you have the angels, you have crowdfundings, and you have different sources. But we need to understand that in the Series A and beyond, we start to have more players. So we are start to have VCs, micro VCs, private equity, merger and acquisitions players, and also corporates. So in this case, we have more information in the financial process. But today I want to keep to talk about this beginning, about the seed, and also how to think in seed when you have the Series A and next the Series B, and why we need to, when we need to do evaluation in startups in this first moment. Of course, when you are investing, so it's an opportunity for us, and we are evaluating this opportunity to do the investment. So at this moment, we are not part of the startup, and we are taking our one decision. But also, maybe you should support the startup to prepare the next financing round. So maybe you can use different methods for these different reasons. But here you, angel, are connected with the startup. So your role is totally different. We know the valuation all depends on who. So a third party is different from the founder and from the angel. So this could be the second main reason. Also, we need sometimes to evaluate the current portfolio and assets. And here, probably we will use another method, some kind about the accounted approach, because maybe this can be connected with taxes. So it's a different reason, a different moment, and maybe with different methods. And also in the end of this process, that in the moment of sell and exiting, that we will evaluate and understand the valuation of our assets. But here probably we will have other players with us, and these decisions will not be just from founders and angels, and maybe you have more VCs and other players participating in this valuation procedure. But you have something common. Usually angels, they are looking for the fair market value, because it's important to achieve them, and because maybe I'm paying more for this startup, and this makes some confusion in this process. And so I bring here, first of all, the definition, just to talk a little bit, but also some tips to deal with the situation about the fair value. So the fair value will be the price. So here we have the word price again, the price that will be received to sell an asset. So it's the transaction with a price, and an orderly transactions, okay, between market participants. Here is not just about the investor and the founders, because the founders has contact other investors, the investors are evaluating other startups in the same space. So they in fact, we have some other participants. Of course, it's fewer than stock market and so on, but it's important in a maturity date. So after that, before that, things change. And today, startups has the seed and the pre-seed financing moment, and then Series A, Series B. So in fact, we will be few moments with this fair value in fact, because it's about the transaction. So my tips about that, it's first of all, not think about the fair value, but think about the relation between risk and return. So we need to find your balance between risk and return, and the return is not the same for all angels, and the expectation of risk is not the same of all angels. So we need to balance with your risk and your return expected. But really important, when you're talking about this valuation, this value, we need to understand that to have different scenarios for that. So in this case, fair value, it's in a maturity date. But when you're talking about entrepreneurial finance, we are talking about uncertainties, a lot of assumptions, and the scenarios could bring you some thoughts on the risk, some thoughts on the return, and maybe give you more information to take your decision. And more important, also, it's about this, the terminal value and exit value is the situation that for for the valuation methods to determine the valuation, you should have this on mind. So what will be the valuation of the start in 5 years? Or if the startup is planning to exit in 4 years, what could be this amount? What could be this valuation? Because these valuations can give you a number to exit, and you can understand and think, how can you invest now based in the risk that you understand, the return that you are expecting, and with this different scenarios. So terminal value, it's really important. And I'm saying this because in the valuation method, it's important, but it's the target, the final goal. So understanding this before invested is important. So we are looking for this kind of market value, the fair market value, this good price about this kind of situation. And we have different approaches, we have different methods, we have different ways to achieve them. So for me, the valuation starts between this balance between risk and return. And then it's about this ratio. But you have mainly two options: comparisons and intrinsic value. Comparison, it's about the relativity that we just starting talking in the beginning. And you have the intrinsic value. It's more about the taxes issues, about the accountant situations, or some liquidation process, or I would say not the best scenarios cases. In the other hand, we have the comparisons, and for comparisons, we have two approaches: the qualitative and the quantitative. And they are used in different moments, and they are really different. So qualitative, we have different methods, for example, scorecard, checklist, risk summation factor, but all of them are based in a comparison. For example, for the scorecard and for the risk summation factor, we need to know the average valuation of the same stage, same geography, same in industry. So to do this kind of qualitative method, we need to understand this average in the same stage, industry, and geography. And for example, the checklist, we need to know the max valuation to invest. So that's why they are comparison, and that's why it's important to go deep on the market and understand the terminal value and the current value. And these three methods, it's about the team. They have some difference. For example, scorecard, it's about the whole team, and checklist, it's about just the founders and the core team. So they have a little bit difference, but in the end, it's about team, product, tech, market, competition, and also scalability. And also we have another kind of approach here in the qualitative. It's about milestones and achievements, because if you have a good understanding about your industry and how works this dynamic of finance cycle, you can understand what kind of milestones will change the valuation. And I can give you some examples here. For example, today you are seeing a lot of SaaS companies with SaaS business model looking to achieve the 1 million in annual recurring revenue, because this is a good milestone for the Series A's and put the startups in a good position to raise the Series A. And this can change the valuation of this good position. Another milestones, for example, in the health tech sector, you have a startup before the FDA approval, and after the FDA approval, you have a totally different valuation for that. So if you know the dynamics of your market industry and understand what kind of milestones will change the valuation, maybe you can use to evaluate your investments, or what is the level of investment valuation of your startups. So this is the qualitative approach. Also, we have the quantitative approach. The quantitative approach, you always will determine the terminal value. In one case, you determine it with current data, with present data. So you can use some ratios and use the current revenue to see, and use a multiple to see the current value. It's more used for public companies and really big companies, but you can use more simple, you can use simpler methods, for example, venture capital and simple multiples that is easier, but also based on quantitative and numbers and financials. But again, why this is a comparison? Because to determine the terminal value, you should have a approach, a methodology to achieve them. For all these kind of methods, you need to find this terminal value for discounted cash flow, for Chicago, and so on. So it's really important to understand what could be the end number of valuation. Today, I bring to talk a little bit about the venture capital method. The venture capital method, it's just a formula. It's the simple way to do the quantitative approach. So in the end, it's just this formula: post-money valuation, terminal value, the hurdle rate, and the years. So here I give you an example. I just bring the number 20 million for the terminal value. Just for the example, we can have different ways to achieve that number, and the idea is not to justify here, but based on this assumption. So in 5 years, the startup will achieve the valuation of 20 million euros. I'm planning to invest 250K right now, and my hurdle rate, it's about 50%. Using this formula, you achieve a number around 2.6 million euros, but you need, this is for the post-money, so less the investment, you will achieve the pre-money valuation of this investment. So here we have the most important topics addressed, because we have the terminal value, we have the hurdle rate that is in the end the balance between the risk and return. Of course, the years is the information based on the financials, and here the investments that we are preparing. So this shows us how some venture capitals are thinking when they are doing investments. First of all, they determine the end valuation. They think how could be the good return on this investment, and then bring this number to the present and use this kind of simple formula. So this, for me, it's a good case just to illustrate how work the thoughts behind some VC investments. And okay, I show you when a lot of methods. We don't have time to go deep in each of one of the methods, but what is important, the valuation timeline. So here I have in the vertical axis, the valuation methods, and in the bottom, the same 3 phases, angel seed, early stage, and mid and late stage. And here you can understand that in the first stage, of course, mostly qualitative cases, qualitative methods. It's important for you to understand what works better for you. It's not smart to use all methods and think what could be the best one for each case, but what could be the best method for you. So if you have this kind of milestone approach, maybe it could be this one. Maybe if you are more concerned about risk, the risk summation factor could work better. And in the other hand, so here in the angel and seed, you have most qualitative. And in the other hand, the traditional valuation, in the late stage, we have the traditional valuation. So discounted cash flow for Chicago, just using public companies comparable to facilitate the process. But what happened in the middle? In the middle, we have a balance between qualitative and quantitative. And this balance is not just about the company. It's not just about the startup that now they had a history and now we can trust in the assumptions because they have some track. And so it's not just about the startup. Of course, the startup has an impact here, but it's about the market, because like I told you before, here we're starting to have, for example, in the early stage, the Series A and Series B, and this is starting to have some floor. So we have this latest funding round with this floor give us some numbers. And also we have some merger and acquisition, in the other hand, with great companies who can give us maybe the terminal value or some expectation on that. And in this middle, we can use more and and achieve better comparables to do the valuation methods. And with better data, better comparables, we can move for more traditional valuation methods. So it's not just about the stage of the startup, but also the information that we have about that. And why this happened? Of course, because we are not have just angels and crowdfunding platforms and bootstrapping. We have the other players who are doing acquisitions, doing merges. So this gives us a moral reality. So in the end, with this, we can have better company comparables. So this dynamic between different methods, it's important to understand. And when we have that, we have better comparables and we have better information from the market. So in the end, it's all about comparables, and comparables about sector and industry, stage and geography. And this is another challenge, because where we can find good information about early stage or pre-seed in the same industry and the same geography. Of course, we don't have a global answer. That's why it's important to work local. Here, I'm just showing some platforms, some sources that you can find some data. For example, Crunchbase, Dealroom, CB Insights, who are trying to achieve this kind of numbers about exits, fundraising, new financing round, but also crowdfunding platforms and secondary market can bring us good information. We have, for example, Seeders, who has some startups with this situation. Associations, but also other players. For example, maybe if you are working in the health tech space, it's important to follow report for important VCs in the health tech space, because they are managing in the field the situation. So this kind of incubator, accelerator, and other corporates could be good for achieve this information. But in the end, for me, it's about field and empirical knowledge. And this is not so easy to achieve. So this kind of sources here, resources, will support you to develop this empirical knowledge, but you need to put the shoes on and go to the field to understand what is important for you. And maybe we can translate what is important for you for what's important for your investment thesis. Because in the end, it's about that. With your investment thesis on mind, and this deep knowledge about the empirical and field knowledge, you can achieve a more assertive valuation. So keep not being a easily mission. So here I will share this presentation after the meeting. So here I just bring some guidelines about valuation. So here you find 5 guidelines about how to apply each method. I just bring 3 important reports about PitchBook and CB Insights, who can provide the mean, the average, and maybe the ticket about some countries and some geographies, but also some websites. For example, Wikidom, it's a valuation platform. They shared the average and max valuation by country. This is not the answer, but this could be a start for you understand the difference between countries, or go check there what is the max and average about your country, could be a good start. Also have Dealroom transactions. They are trying to say some exit multiples and another kind of multiples you can check later. And then you have this kind of difficult to understand comparables, and you have different business models, different states, different targets, and different metrics. So here I bring for me the most important, and for me you have 2 kinds of metrics, the customer and the financials, and both are important. Maybe customer before in the beginning and later financials before. And for each one of these, you can go deep, but I selected 4 just to comment on that. And later in the question and answer, you can address it some other metrics. But for me, the customer, we can talk about the total addressable market and customer acquisition cost. total addressed market is not just about the 2 billion market that we are addressing, because this kind of answer, it's the poor one. This kind of metric, it's interesting to understand how deep the founder and the core team knows about the industry. So going deep on this kind of information and provide us some good segmentation and talk about who are the big players, who are the potential players who can do a merge and acquisition. This kind of information, this deep information, can show us more than just the big number about this total addressable market. And another important question is how and why this is the total addressable market for you. Because sometimes we have founders in love with his solutions and maybe this is not the right answer. So we need to care about this number, and this number can support the next rounds and next phases. The second point is about the customer acquisition cost. For me, of course, this is for me and for others, but we have two great points about this metric. The first one, of course, we can measure how much costs to growth, of course. So this is the first reason to use it. But for me and for others, this kind of metric show how much the entrepreneur and the founder knows about the dynamic behind the business, how it works and where he needs to change to achieve a better result and so on. So this kind of metric, we don't have a rule to achieve them, and it's usually to have a question. So how did you calculate your CAC? Because each entrepreneur is using a different way, but not assumptions, but the thoughts behind can give us how deep the entrepreneur already know about his business. About financials who can be used in the seed and Series A phase, I just want to talk about the ratio between lifetime value and customer acquisition cost. Of course, this metric should be higher than 1 to be profitable, higher than 3 starting to be interesting, and higher than 5 really interesting. It's really good metric. Yesterday I was talking about entrepreneurs who are using this kind of metric, and this kind of metric, again, we always asking how they are calculating, because we have different ways, and we need to care about this metric about time, because we can have, for example, three times this ratio in 1 year or 3 times in 5 years. So for each metric, we need to understand case and go deep, but for sure this one is one of the hosted one right now. And just to conclude, we have the enterprise value ratio with annual recurring revenue. I just mentioned about the SaaS companies looking for 1 million. So right now in the seed and Series A, we are having, for example, fintechs with 14 times the annual recurring revenue. We have biotechs and health techs with 20 times the annual, but also on the other hand, in other sectors, we have numbers around 6 and 7. We are seeing deflation of valuations in the US. So of course, this is starting the top and going top down, and we will see the effect in startups in the future. But yeah, you are seeing huge numbers for trends, for example, biotech, DeFi, and deep technologies, and lower numbers for traditional as well. And just to conclude, I just want to talk about some terms that will affect our decisions. So I bring here liquidation preference, pro rata, anti-dilution, drag-along, tag-along, and right of first refusal. Because when you're talking about valuation, sometimes we're just talking about the number, about the value, and we can balance with some terms, and you can understand that maybe if you are not taking care about the terms, all the calculation that you did before will be wrong, because the next financial rounds will have this kind of terms, and we are seeing VCs asking for 1 time, 2 times liquidation preference. So maybe with a not so well exit about the startups, you can have your gains on risk. So that's why it's important to at least understand how it works, to understand, because maybe you can pay a higher valuation with one of these terms, or paying a lower valuation without one of these terms. So we need to understand. So here it's about the liquidation preference, and we are seeing that can be one time the money invested, or multiple, 2 times, 2.5, more than that could be a problem. And also we have the participating and non-participating, so you can receive this money after the company being sold, but not participate in the rest, or participating. So also you can consider in this situation. The second point, it's about dilution. So dilution can, of course, will affect your return on the investment. So these two terms, pro rata and anti-dilution, can give you some security. So for pro rata, this give you a right to maintain your position, to keep the same ownership, of course, investing what need in the moment. But we have here, for example, anti-dilution, who can give a huge advantage in some cases. So they are two deal terms who can support on your decision about valuation. And just to conclude here, you can consider in these terms about control, but also can be very effective when you're talking about economic gains. So have your voice in this kind of decision, or be part of the sale, could be a good way to close the cycle. Conclusions. Best practice vary by sector and stage. There is no single valuation method for all cases. Valuation, it's all about comparables. So you need to understand your market, you need to understand your competitors, you need to understand what kind of exits are having in your space, because this will give you advantage. Empirical knowledge is essential for understanding and defining valuations. So to be more assertive probably is the key. Have this empirical knowledge. And just to conclude, valuation is only one element in the equation, so we need to consider in all these elements that I mentioned, and not just about 10 million, 3 million, 1 million, half million, and so on. So thank you very much for your attention. I'm ready for questions and comments, and feel free to